All right, so for more on the U.S. economy and the Fed, we're joined by John Allison, CEO of Unio Capital. John, Happy New Year. Always good to see you. Thanks for joining us.
Happy New Year to you, too.
John, let's start off by looking at the Fed's meetings that were released today. And we're learning that inflation was a very big concern, so much so that the Fed almost didn't make the decision to hike up rates by 0.25%. Why is low inflation such a big concern? What would the consequences of that be?
Well, low inflation can lead to disinflation, can lead to deflation, and deflation is very hard to get out of. And that's why the Fed is being super cautious in not wanting to raise rates and, before inflation really starts to actually get some traction. So I think actually their caution is a very positive thing because they're actually being careful in the gradualism with which they raise rates, which actually is positive for the economy because it means there's not going to be nothing sudden and no sort of sudden setbacks, at least those caused by the monetary authorities. So I think actually that's a positive thing that they're so cautious.
All right. They were cautionary, but they still made the move. And in light of what we've seen, markets, tanking so far this year. Some are even saying we're heading into correction territory. Some slowing growth out of China, some Middle East tensions and oil being very volatile towards the downtrend. Was this the right call from the Fed?
Yeah, I think it was absolutely the right call. I think the Fed put a stake in the ground and said, we've got to start normalizing. 25 basis points is, from a real standpoint, almost nothing. We also think they're going to raise rates very slowly this year. So it's not in our view, that's not the big deal. As I was saying to you before the show, I think it's more psychological. The market has had the Wizard of Oz of the Fed, of the ECB, and all the central banks, and all of a sudden some of this support is being withdrawn, and people are at sea, they don't know what to do, and they're feeling they don't have this nanny to help them along. I think part of the problem is that.
But the Fed was guiding them towards this withdrawal for the longest time.
It's true, but it's like a little child, who's sort of let go to go to school. It's a thing to be prepared for. It's another thing to be walking down the street by yourself. So I think there's that issue. And the other one that I mentioned to you is that this has unleashed are two kinds of investors that we see out there, and I would really urge your audience to think about what we call macro tourists, people who don't have a particularly profound view of the macros, who are weaving all sorts of scary stories as we see today, and what I would call sort of 10,000-foot stock pickers, people who are not getting into the fundamentals very deeply, but are making thematic bets, and these people are sort of dominating the markets right now.
But John, if you do look at the economy at large, there is a lot of weakness and cause for concern. Wages aren't rising. Unemployment is low, but the participation rate is also very low. And we've also got to take into account what's happening with oil, because a lot of the recovery was underpinned by the domestic energy boom. Now oil prices are tanking. That's going to have implications. Do you really think that the economy is strong enough to support this rate hike and yet another one?
Yes, I think
in a word, yes.
I think it. First of all, just factually, some of the things you say are perfectly correct, but at the same time, private demand, which is a big part of the 70% of the economy, is actually at pre-crisis levels. Employment, with the problems you cite, is actually growing. The economy is actually not very strong, but it's strong. And I think one of the things people are underestimating is whether this economy can expand for a much longer time than people think. There's a lot of fear that we're at the precipice where we'll sort of end this economic expansion. We don't think that we are.
And how does China factor into all of this?
China is the world's biggest risk, as I've said on your show before, but the Chinese are also very aware of the challenge of moving from a capital goods-based economy to a consumer and services economy, so they're actually aware of it. They're doing something about it. I have incredible confidence in the Chinese industriousness and intelligence, so I think this is hardly a country that's sort of asleep at the switch. This is a country that's trying to make the change. Is it going to be rough? Yes, it's going to be rough. Is it going to be difficult? Yes, but I think they're actually facing the challenge. So that's actually a positive, not a negative.
But at the same time, with China in the equation, as well as other emerging markets and other markets, and the Fed interest rate hike, we've got the dollar strengthening and strengthening. And John, keeping in mind that about 40% of S&P 500 companies' revenue comes from overseas, 25% of the profits of S&P 500 companies comes from overseas, the strong dollar is going to hit into their competitiveness, into exports, into profitability. You're not worried about that?
Well, I don't want to be just a Pollyanna here, but you're right. I mean, the dollar is a drag. There's no doubt about it, and it does hurt earnings. It also makes companies somewhat stronger. You know, when you have that drag, you also try to do better. And also, I think we're of the view that the dollar is getting relatively close, and by that I mean sort of within 10 to 15% of reaching a high. So I don't think this suffering with the dollar is going to go on and on forever. I think it's going to reach a point where, you know, the worst is behind us.
All right, you're painting a very bright picture, and I like it. Now, John, in December, the Fed said that by the end of 2016. It says interest rates at about 1.25%. What do you think is going to happen? When do you see the next rate hike?
First of all, we don't think it's going to get that high. We think they're optimistic. The economy is, as I said, strong, but not that strong. So we think it's going to go up maybe by another 50 basis points to maybe 1% this year, rather than 1.25. We think maybe another 2 hikes this year, rather than the 4 that many are expecting. Maybe a quarter, first half, a quarter, the second half. It's all data dependent. Labor markets are strong. Inflation is high. Obviously, that'll change, and they'll do more. But our gets
erring on the side of caution. All right, thank you so much, John Allison, CEO of Unio Capital.